Welcome back to Finance Supergirl, your ultimate destination for decoding complex financial topics. In today's episode, we're diving deep into the fascinating world of interest rates and how they can profoundly impact your finances. Get ready to unlock the secrets behind interest rate fluctuations and gain the knowledge you need to make informed financial decisions. Section 1. Understanding interest rates and their significance. What are interest rates? Let's start by understanding what interest rates are. In the realm of finance, interest rates refer to the cost of borrowing money or the return on investments. They affect various aspects of our financial lives, from loans and mortgages to savings accounts and investment returns. Factors influencing interest rates. Now, let's delve into the factors that influence interest rates. By understanding these factors, we can grasp why interest rates fluctuate and how they impact our financial landscape. Central banks and monetary policy. Central banks, such as the Federal Reserve in the United States, have a significant role in shaping interest rates through their monetary policy decisions. They use tools like adjusting the benchmark interest rate, known as the federal funds rate, to influence borrowing costs and stimulate or stabilize the economy. Economic indicators and market expectations. Economic indicators and market expectations also play a crucial role in determining interest rates. Factors like GDP growth, inflation rates, and unemployment levels provide insights into the economy's overall health. Positive economic indicators and optimistic market expectations can lead to higher interest rates, while negative indicators can prompt lower interest rates. Inflationary pressures. Inflation, the rate at which prices of goods and services rise, directly impacts interest rates. Central banks aim to keep inflation in check by adjusting interest rates accordingly. When inflationary pressures rise, central banks may increase rates to curb excessive borrowing and spending, thus managing inflation. Market forces. Supply and demand. The dynamics of supply and demand in financial markets also influence interest rates. When there is high demand for borrowing, such as during periods of economic expansion or when businesses and individuals seek loans, interest rates tend to rise due to increased competition for available funds. Conversely, when borrowing demand is low, interest rates may decrease to encourage borrowing and stimulate economic activity. Section 2. Unraveling the impact of interest rate changes. Borrowing costs and mortgage rates. One of the most direct effects of interest rate changes is on borrowing costs and mortgage rates. When interest rates rise, the cost of borrowing increases, resulting in higher mortgage rates. For example, a 1% increase in interest rates can significantly increase monthly mortgage payments. If you have a $300,000 mortgage with a 30-year term, a 1% increase in interest rates can raise your monthly payment by around $200. Savings and investment returns. Interest rate changes also have an impact on savings and investment returns. When interest rates are low, savings accounts and fixed income investments such as bonds may offer lower yields. For instance, during periods of low interest rates, the yields on savings accounts may be around 1% or even less. Conversely, higher interest rates can provide opportunities for higher returns on savings and fixed income investments. For example, a rise in interest rates from 1% to 4% can potentially triple the interest earned on savings. Impact on businesses and consumer spending. Interest rates can influence businesses and consumer spending patterns. Lower interest rates can encourage businesses to borrow and invest in expansion, stimulating economic growth. Lower rates can make borrowing more affordable for consumers, increasing spending on big-ticket items like homes and cars. For example, when interest rates are low, it becomes more attractive for businesses to take out loans to invest in new equipment or hire more employees, boosting economic activity. Stock market and investment strategies. Interest rate changes can also have an effect on the stock market and investment strategies. When interest rates rise, investors may shift their focus away from stocks to fixed income investments, potentially leading to a decline in stock prices. Conversely, investors may find stocks more attractive when interest rates fall due to the potential for higher returns. For instance, during periods of low interest rates, investors may be more inclined to invest in stocks to seek higher yields than other investment options. Section 3. Strategies to navigate changing interest rate environments. Refinancing and loan repayment strategies. One strategy to consider in a changing interest rate environment is refinancing existing loans or adjusting loan repayment strategies. Refinancing a mortgage or other loans can lower your monthly payments and save you money over the long term when interest rates decline. Conversely, accelerating your loan repayment schedule can help you avoid higher interest costs if interest rates are rising. For example, making extra payments towards your mortgage principal can reduce the total interest paid and shorten the loan term. Investment diversification. Diversifying your investment portfolio is another important strategy to navigate changing interest rates. By spreading your investments across different asset classes, such as stocks, bonds, real estate, and commodities, you can potentially mitigate the impact of interest rate changes on your overall portfolio. For instance, during periods of rising interest rates, bond prices may decline, but stocks or real estate investments could offer better potential returns. A well-diversified portfolio can help balance risks and opportunities in different market conditions. Adjusting savings and debt management. In a changing interest rate environment, it's important to review your savings and debt management strategies. If interest rates are falling, it may be a good time to consider refinancing higher interest debt, such as credit cards or personal loans, to take advantage of lower rates. On the savings side, you might want to explore higher yield savings accounts or other investment vehicles that offer better returns than traditional savings accounts. By adjusting your savings and debt management strategies, you can optimize your financial situation. Long-term financial planning. Lastly, long-term financial planning plays a crucial role in navigating changing interest rate environments. Whether you're saving for retirement, education, or other long-term goals, it's important to consider the impact of interest rate changes on your financial plans. For example, if you're investing in retirement accounts, understanding how interest rates can affect the growth of your investments over time is essential. By taking a long-term perspective and regularly reviewing and adjusting your financial plans, you can stay on track to achieve your goals. Navigating the ever-changing interest rate environment requires a proactive and informed approach. By implementing these strategies, refinancing and loan repayment, investment diversification, adjusting savings and debt management, and long-term financial planning, you can adapt to the impact of interest rate changes and make the most of prevailing market conditions. With these strategies in your financial toolkit, you're better equipped to navigate the twists and turns of the interest rate landscape. Remember, staying informed, being proactive, and seeking professional advice when needed are key to optimizing your financial well-being. Thank you for joining us in this insightful discussion on how changing interest rates affect your finances. Be sure to subscribe to our channel for more valuable content, and don't forget to hit that like button if you found this video helpful. Until next time, stay financially empowered.